Hey traders! Welcome back. You ever open up a chart, spot a clean swing low, think this is it, and boom, price tags that exact level, takes you out, and then reverses? Yeah. That's what we're diving into today. In this session, we're breaking down something that every serious price action trader needs to understand: internal versus external range liquidity. If you've ever been faked out by a stop run or watched price rip through a level just to reverse 5 seconds later, this one's for you. We'll cover what is external and internal liquidity, how institutions actually hunt liquidity, what fair value gaps are really telling you, and how to align your entries with where the real orders are flowing. Let's get into it. What is external liquidity? Let's keep it simple. External liquidity is sitting at the obvious spots: old highs and lows. You know, the ones where everyone's stop loss is chilling. These levels light up like neon signs to smart money. That's why price often grabs those levels before making a serious move. Ever had price barely nick your stop at a previous low and then shoot up 100 pips? Yeah. That's not random. On the other hand, internal range liquidity forms when the market creates a valid swing high and swing low. As price enters a correction phase, it often returns to certain zones left behind by the previous move, zones that still hold liquidity. Depending on how price moved before, these areas can show up in different ways. One common type of internal liquidity is found in fair value gaps, imbalances in price that the market often comes back to in order to fill or rebalance. These gaps are especially important for ICT traders. In a bullish market, traders usually look for FVGs in discount zones, and then drill down to smaller timeframes to find precise trade setups. In a bearish market, the focus shifts to FVGs in premium zones. If there's an order block near that area, it's considered a more reliable signal. If not, traders often refine their entries using lower timeframes. Sometimes, after forming a new swing high or low, the market may enter a consolidation phase. This is where institutions and big players begin building their positions through accumulation or distribution. During this range-bound phase, both buyers and sellers place stop losses at key levels, creating liquidity on both sides. These setups give smart money the perfect excuse to make a move that works in their favor, gathering large positions while trapping retail traders. In other cases, the market might create minor highs and lows, especially equal highs or equal lows. These levels often trick retail traders, making them think the structure is solid, while in reality, they just become liquidity pools for bigger players. Now here's the important part. The market operates in a very simple way. It either draws price toward external liquidity, meaning those old highs and lows, or it rebalances internal inefficiencies, which are the fair value gaps. This behavior is part of the natural order flow of the market. Let's simplify market structure by imagining it as a rally wave, composed of a high and a low. These highs and lows, they represent external liquidity, the points where liquidity builds up and eventually gets swept. Now, within the range of that rally, between the high and the low, you'll often spot fair value gaps. These are what we call internal liquidity. They're the imbalances left behind as price moves too aggressively in one direction, and the market tends to come back to fill these gaps. Here's an important point: when you zoom into a lower time frame, you'll see tons of minor highs, lows, and structural shifts. But if you zoom out to a higher time frame, many of those smaller structures will simply appear as fair value gaps. In essence, price constantly rotates between two key types of liquidity: internal, fair value gaps; external, swing highs and lows. Now, the key question is whether price is more likely to move toward the upper external liquidity or the lower one. To determine this, it's important to first analyze the prior order flow on a higher time frame or assess the broader trend within the same time frame by zooming out. If the market has been in a clear downtrend, it would be logical to expect a continuation to the downside, breaking previous structure and aiming for the liquidity below recent lows. On the other hand, if the higher time frame shows an uptrend, the more probable outcome is a push upward to target the liquidity resting above recent highs. Another important element in forecasting price direction is observing how price behaves when it reaches a fair value gap. If the FVG holds and price shows a strong rejection to the upside, It suggests bullish strength and increases the likelihood of a move toward upper external liquidity. However, if the price shows little to no reaction within the FVG, it may imply that the bearish pressure is stronger and that the market could seek the liquidity below recent lows. Think of it as a cycle. Price moves from external to internal, a swing high to an FVG, or from internal to external, an FVG to a liquidity high. Imagine a drop wave. Price pushes down and sweeps external liquidity below a previous low. Then, it retraces to internal liquidity, a fair value gap left behind within the wave. Next, it pushes down again to reach the next external liquidity zone, sweeping another low. With liquidity cleared, the market reverses to rebalance by filling the next internal fair value gap below. This cycle repeats: sweep a low, fill a gap, sweep another low, fill another gap. It's a simple, elegant rhythm that the market follows, and once you learn to identify this pattern, your entries, targets, and timing become much more precise. So how does this help us as traders? Well, when internal range liquidity is taken out, for example, when a fair value gap is filled, it can be a signal that price is now aiming for external range liquidity next. Conversely, when external liquidity is swept, such as when price grabs an old high, it often signals a reversal or a drawback toward internal liquidity zones, like a nearby imbalance. Understanding this dynamic, this back and forth between internal and external liquidity, can give you a real edge in anticipating market moves. This is where everything starts to come together. By analyzing how price interacts with internal and external range liquidity on these higher timeframes, you'll be able to form a high-probability daily bias. This is the real key to understanding where price is likely headed. See, when you truly grasp the relationship between internal and external liquidity, it becomes much easier to anticipate the next draw on price. And that's exactly what helps you build confidence in your directional bias. Now, let's talk about time frame alignment in relation to internal and external liquidity. Here's what you want to do. When you're trying to establish your bias, whether it's for the week or for the day, you should always start with the higher time frames. Look for market structure shifts or breaks that occur at significant levels, and those significant levels are usually your internal or external range liquidity zones. So, for example, if you see a major shift in structure near an old high on the weekly chart, that's a key clue. That level, being an external liquidity zone, can tell you a lot about where the market is likely to go next on lower timeframes. By building your analysis this way, top-down from higher timeframes to lower ones, you'll not only stay aligned with the market's intent, you'll also avoid getting caught in false moves that are just liquidity grabs. At that point, your job is not to immediately take a trade, but to zoom into the daily chart and watch how price reacts to that monthly level. What you're looking for is a market structure shift off that level on the daily time frame. Once you get that shift, meaning a clear break in structure in the direction of the higher time frame bias, that's your trigger. That shift confirms whether a buy or sell program is being initiated, depending on the nature of the order flow. The same concept applies across all time frames. For example, from the weekly chart, you drop down and watch the 4-hour chart for a reaction at a key weekly level, whether that level is external liquidity like an old high, or internal like a fair value gap. From the daily, drop to the hourly. From the 4-hour, drop to the 15-minute. From the hourly, you can go to the 5-minute or 1-minute if you're a scalper or looking for precise entries. This process is called timeframe alignment. You're essentially confirming the intent of the higher timeframe by watching for reactive structure changes on the lower timeframe. By doing this, you're not just guessing, you're aligning with institutional order flow and stacking probabilities in your favor. Now let's take everything we've discussed and apply it visually with a model, specifically, the Market Maker by model. This model will give you a structured framework to base your entries on, especially when you're aligning multiple timeframes and identifying key liquidity zones. Let's start by imagining that price is reaching into a higher timeframe external range liquidity pool, for example, a significant sell-side liquidity run, like sweeping a key low on the daily, weekly, or monthly chart. Label this point as sell-side liquidity. It could be equal lows, a clean swing low, or any point where stop losses would be resting. Now, once this external liquidity has been swept, that's our first signal to prepare for a potential reversal. Once that sweep happens, you want to drop down one time frame, If the sweep happened on the monthly, go to the daily. If it was on the weekly, drop to the 4-hour. If on the daily, move to the 1-hour. Now on this lower time frame, watch for a market structure shift, your confirmation that the market is reacting to that higher time frame liquidity. And here's where you can add another layer of confluence, SMT divergence. When price hits these key levels, and you see divergence between related pairs or indices, it strengthens the case for a reversal. Now let's say you're watching the 1-hour chart, and price closes above a swing high. That swing high is, in itself, a form of external range liquidity on the 1-hour. What's likely to happen next? Price will retrace, and where does it usually go? It will often drop into internal range liquidity, specifically, a fair value gap or a breaker block within that 1-hour structure. If that fair value gap lines up with a breaker block, that's a high probability entry zone. And if you also had SMT divergence at the lows before the shift, that's a strong confluence stack. Once price reacts and confirms the direction, we can frame this entire move as part of a market maker buy model where price is transitioning from taking external liquidity, the low sweep, and is now drawing toward internal range liquidity, like a fair value gap on the higher time frame. This internal liquidity should ideally be located in premium, meaning it's above the 50% level of the range created by the swing low, which swept external liquidity, and the new energetic swing high. As price moves toward its draw on liquidity, you'll often find PD arrays forming along the way, like order blocks, mitigation blocks, or other forms of accumulation and reaccumulation. These areas, typically located on the sell side of the curve, can act as launch points for continuation moves, helping price reach that internal range liquidity pool, which often aligns with consolidation areas or fair value gaps left behind during impulsive price movements. So remember, this entire model is fractal. A 1-hour swing high is external liquidity on that time frame, and price responds to it the same way it would on the daily or weekly. Your job is to watch how price reacts at each of these key levels and structure your entries based on these reactions. By following this model, you're aligning yourself with institutional order flow and basing trades on logic, not emotion. Alright, let's walk through an example together on the chart. Here we've got the 4-hour chart of euro. After a structure break and internal liquidity grab, price resumed its bullish trend. At this point, we see price pulling back into the internal range of the newly formed bullish leg. So, our expectation is that price might return again to clear more internal liquidity. Step 1 is identifying that internal liquidity. In this case, we've got one FVG and 2 order blocks. The FVG isn't valid for us because it's already been tapped and is sitting in a premium zone. That leaves us with the 2 order blocks in the discount zone as our main area of interest. To refine our entry and look for a proper reaction, we drop down to the 15-minute time frame. Once price reaches our zone, we're looking for 2 confirmations, a break of structure and SMT divergence. Here, we spot SMT divergence with the dollar index, which gives us the first confirmation. Then, after the structure break, we look for the first valid PD array, in this case, an FVG that forms in the discount after the break, and that's where we take our buy entry, aiming for the next external liquidity level. Your target is the next liquidity pool, and your stop loss goes just below the low that tagged the internal liquidity zone. This is a clean, structured trade, and it's a perfect example of using multi-time frame alignment, SMT divergence, and liquidity theory all in one. It's all about being patient and waiting for the market to come to your zone. Always remember, confirmation is key. Don't jump in just because price touches a level. Let the market show you its hand first. Stick to your plan, manage your risk, and trust the process. See you on the next video.